Investing in the ETFs. So I've been investing for the long term. It's so hard to beat S&P 500 returns. So in the last 5 years, S&P 500 has given over 90% in returns. And I heard many people in the short term, they say that I beat S&P 500. S&P 500 gave only 7% return, whereas my portfolio has given 15% return. So I'm doubling S&P 500. But the thing is that in long term, let's say 5, 10, 15 or 20 years, beating S&P 500 is not easy as it sounds. And many hedge fund managers, as we know the story of Warren Buffett, he said that he bet against many hedge fund managers for the next 10 years what will have a good returns, S&P 500 or the stocks picked up by hedge fund. And Warren Buffett no doubt wins the bet that S&P 500 beats the stocks picked up by hedge fund managers. So hedge fund managers, their full-time job is to beat S&P 500 and pick best stocks for their client. But still, they were behind S&P 500 returns. So investing in a good ETF for the long term is a good choice. So I'm doing pretty good with my ETFs right now. But when I started back in 2019 or around 2020, there were some of the mistakes that when I look behind that I have made, that if I have not made those mistakes, I should have saved more than $3 to $4 to or even $5,000. So those are the mistakes that I'm going to talk about today. So if you're new to investing and you're thinking about investing in a good index fund or ETF, then this video is for you. So in 2019, when I started investing, there was two ETFs, VFV, S&P 500. So S&P 500 trade in US stock exchange, and VF, it tracks S&P 500 index, but it trades in Toronto exchange. So for some reason, I had less knowledge about how ETF works. I started investing in VFB and S&P 500 SPY ETF both at the same time. And basically, I'm just putting my money on the same ETFs but in different exchange, like one in Toronto exchange, one is New York Stock Exchange. So that was a mistake. I should have been just investing in VFB because I live in Canada, so I don't have to worry about foreign exchange fees. But I started investing in S&P 500, which basically tracked top 500 US companies, and also in VFB, which also tracks S&P 500 index. And also with that, there are many people that invest in different index funds or ETFs that just overlap each other. I know QQQ and S&P 500, they both are good choice, but they also overlap each other a little bit. But there are many other ETFs that overlap each other by 90% or even 80% or 95%. So basically, if you're investing in S&P 500, you're just better off not pick any other similar ETF that also track S&P 500 a lot. So that was the first mistake. Don't invest in ETFs that overlap each other. Mistake number 2 I made is that holding SCHD ETF in my tax-free savings account. And we all know that SCHD is known for its good dividend, 3 to 4% of dividend every year. And that's why people invest in SCHD, because when the stock market falls, SCHD doesn't go too low. So we can rely on the dividends when the stock market is low. So we can just use it to hedge the stock market. So with the SCHD in tax-free savings account, every time SCHD pays me dividend, every 3 months they pay you dividend. So they pay you dividend 4 times a year. So whenever SCHD pays me dividend in my tax-free savings account, the dividend got reduced by 15%. So I only get to keep 85% of those dividend. And that tax is called withholding tax. So whenever you own a US company like SCHD or any other stock like Microsoft, Nvidia or Apple that pays you dividend, US takes 15% as a withholding tax. And I didn't know that. So SCHD is a long-term investment. It doesn't matter if the stocks that doesn't pay you dividend, you can always hold them in tax-free savings account. But ETFs like SCHD, they pay you regular dividend. So the best idea is to invest through your RRSP, because those types of investments are for the long term and you better off just keep them in RRSP rather than just paying 15% in withholding tax. And those 15% adds up a lot if you look at next 20, 30 or even 40 years. Mistake number 3, sell during the dip. So I started investing in 2020 when there was a COVID, and we all know that March, the stock market dipped by I think 20 or 30%. So I started investing back then. And after that, we had a good rally in 2021 or at the end of 2022, market rally to the upside. And market was doing pretty good in 2021. And by the starting of 2022, the market dipped. So the market kept on falling 20% for 1 year or so. So I had a good amount of S&P 500 SPY ETF then. But I sold some of the SPY ETF. I don't know which influencer I was listening to. They say that the stock market is going to fall, keep on falling for next 3 to 4 years. So just to be risk-free, I sold some of my S&P 500 position. So the thing here to learn is that whenever you're holding your long-term ETFs, there is no need to sell them when the market dips. It's always the good idea to do dollar cost averaging. So the market is at all-time high, invest then. Market is falling, invest then too. The market is at the bottom, then invest. And don't sell it when you see the market is scary, because dollar cost averaging is the way to build long-term wealth. Because not even the top hedge fund managers, they can't even time the market. And as Warren Buffett and Charlie Munger say, time in the market is better than timing the market. Nobody can time the market, and nobody knows what's the market gonna do in next 5-6 years. Market gonna go up or market gonna go down. Nobody knows that. So time in the market is always a good idea. And another thing, when investing in ETF, it's not a mistake that I have made, but I see many people made this mistake. There are some of the ETF in the market that has high expense ratio. And I even consider 0.40, it's a high expense ratio. You can get similar ETF at a less fees. Always explore your options. I see many people, they start investing in an ETF and doesn't look what kind of fees they charge. So always in a Wealthsimple app on the bottom right corner, there is always the expense ratio that you can check. And I always recommend go to 0.20, that's it. Stay below 0.20. And many of my ETFs, they only charge 0.08 or 0.02, that's it. And if you're a beginner in the ETF, there are 3 ETFs that I've been investing from very long time, and I always recommend to invest in these ETFs so you get full diversification. So S&P 500 ETF, if you live in Canada, then VFV is a good option. Second is QQQ, and I've been investing in QQQ from a very long time as well, and it gives me more returns than S&P 500. But also when the dip comes, when there is a correction in the market, QQQ falls more than S&P 500 because it's more risky. And the third, I've been investing in SCHD. So to collect regular dividend, to collect regular cash flow. And those are all my long-term investments. I'm not planning to sell them in near future, 5 to 10 to 15 years. I've been holding them for next 20, 30 or 40 years. And if you like anything from this video, please like this video. And if you want me to make a video on anything, especially for Canadians, let me know in comments and subscribe to my YouTube channel.